Microsoft just delivered an exceptionally promising earnings report that proves their growth engine is unstoppable. For Q3 FY26, total revenue violently expanded to $82.9 billion, a massive 18% year-over-year explosion that completely vaporized Wall Street's estimates. Productivity and business processes delivered $35 billion, up 17%. Intelligent Cloud roared ahead at $34.7 billion, up a staggering 30%. More personal computing fortified the base with $13.2 billion. The margins are ruthless. Gross profit hit $56.1 billion at a massive 68% margin. Operating income stood strong at $38.4 billion with a 46% margin. But the kill shot? Net income reached a towering $31.8 billion. And the EPS? A flawless $4.27, violently crushing the $4.06 estimate. This isn't just a beat. It is a declaration of absolute monopoly. Peel back the segments to expose the true architecture of this $82.9 billion quarter. While traditional hardware, Windows OEM, and device segments experience a deliberate, strategic contraction, the software and cloud engines are absolutely detonating. Azure and cloud services alone printed $32.6 billion, up a jaw-dropping 32%. The commercial backbone remains absolute, with Microsoft 365 Commercial generating $25.6 billion. Microsoft 365 Consumer injected another $2.3 billion, surging 26%. LinkedIn quietly drove $4.8 billion, while Dynamics 365 violently expanded 19% to $2.3 billion. The blueprint is undeniable. A ruthless shift of every single dollar from cyclical hardware straight into hyper-scalable, high-margin cloud and AI services. Look at the sheer velocity of this multi-year expansion. Total quarterly revenue has climbed a near-unbroken staircase, scaling from $56.5 billion in early FY24 straight to a towering $82.9 billion today. Note that historical baselines shifted slightly when Office was strategically reclassified into Microsoft 365, but the growth trajectory remains flawless. The profit engine behind this revenue is equally ruthless. Productivity and business processes commands a massive 60% operating margin, making it the most lucrative pillar in the portfolio. Intelligent Cloud has compressed from 48% down to 40%, an anticipated and calculated cost of laying down the physical infrastructure for the global AI supercycle. Meanwhile, more personal computing stabilizes at 28%. The capital expenditure cycle is immense, but it is forging an indestructible margin architecture for the next decade, tearing deeper into the core segments. Intelligent Cloud is the ultimate AI growth engine. Azure violently surged 40%, marking its fifth consecutive quarter of acceleration. The absolute kill shot here is Microsoft's AI revenue crossing a $37 billion annual run rate, compounding at a terrifying 123%. Building this infrastructure drove cost of revenue up $4.8 billion, yet the segment still squeezed out $3.1 billion in pure incremental gross profit. In productivity and business processes, commercial seats grew a steady 6%, but cloud revenue skyrocketed 19%. That massive 13-point gap is pure pricing power at work, fueled by enterprise E5 suite upgrades and a 250% surge in paid Copilot users, now crossing 20 million seats with engagement rivaling Outlook. Finally, more personal computing executed a masterclass in margin engineering. Xbox hardware sales collapsed 33% in a deliberate retreat from low-margin boxes. But by starving these loss leaders, segment costs actually fell 10%. Saving $584 million and boosting gross profit by 6%. They are engineering profitability piece by piece. The global cloud infrastructure market is the defining battleground of this decade, detonating to $129 billion in a single quarter with 35% year-over-year growth. Amazon Web Services still holds the lead at 28%, and Google Cloud Platform commands 14%. But the true momentum belongs entirely to Microsoft Azure. Over the last 4 years, while AWS gradually bled market share from 33% down to 28%, Azure has been relentlessly hunting them down, ripping its share from 16% to a commanding 21%. This isn't a short-term spike. It is 4 years of unbroken, compounding market share gains. With Azure's operating profit hitting $13.7 billion this quarter alone, the hyperscaler arms race is accelerating, and Microsoft is violently seizing the throne. Microsoft 365 is the ironclad subscription backbone. Commercial seats didn't just grow. They compounded from 311 million in early FY22 to a staggering 456 million today. That's a 7.2% CAGR. Consumer subscriptions exploded from 54 million to 94 million at a 12.8% clip. But seat growth is just the floor. ARPU expansion is the absolute kill zone. By weaponizing the $30 Copilot add-on and forcing E5 upgrades, Microsoft is extracting exponentially more cash from the existing user base. At 456 million seats, even a fractional Copilot attach rate prints billions in pure, high-margin software revenue. LinkedIn is an absolute stealth juggernaut. Acquired for $26 billion, it now commands a staggering 1.3 billion global members. The US base sits at 256 million, with India exploding to 179 million. Users are compounding at 11.7% annually, but the revenue trajectory is a vertical ascent, firing from under $2 billion in FY20 straight to nearly $5 billion in Q3 FY26. That's a 15.4% revenue CAGR, outrunning user growth. Driven by AI-powered recruiting and premium tier expansion, LinkedIn surged 12% this quarter alone, injecting $521 million in pure software margin with zero hardware drag. Dynamics 365 is Microsoft's ruthless assault on the enterprise software monopoly. In CRM, they hold 4% against Salesforce's 23.7%. In ERP, they command 6.6%, hunting SAP's 16.4%. The TAM is massive. CRM is rocketing toward a $158 billion market by 2030, and ERP is charging toward $123 billion. But here is the shockwave. Dynamics 365 is violently compounding at 22% year over year right now. By weaponizing AI natively into these workflows, Microsoft is positioned to ruthlessly strip market share from legacy vendors who are too slow to adapt. The global digital ad market is an $869 billion battlefield, and Microsoft is out for blood. Alphabet and Meta command the heights with $229 billion and $220 billion. Microsoft sits at $19 billion, merging Bing's $10.67 billion with LinkedIn's $8.33 billion. But the real kill shot? Bing's global search market share. It bottomed at 2.4% in 2019, but powered by Copilot integration, it has violently surged to 5.1% in 2026. This is the steepest market share expansion in a decade. With search ads controlling 29% of this near trillion-dollar market, every single basis point of share Bing steals translates to billions in pure, compounding revenue. Microsoft's gaming architecture is being brutally and brilliantly restructured. The old hardware business is bleeding out, collapsing down to just $250 million this quarter. Selling cyclical, low-margin boxes is a dead model. But content and services? That is the high-margin, recurring growth engine. Since swallowing Activision Blizzard for $75.4 billion, this segment exploded, stabilizing at a massive $5.1 to $5.3 billion every single quarter. The blueprint is absolute. Terminate hardware losses, weaponize Game Pass, leverage Activision's IP, and dominate the mobile ecosystem. The true Xbox monopoly is just waking up. This is the master blueprint for absolute AI supremacy. The hyperscaler battlefield is a war of three kingdoms over a $129 billion market. AWS defends $150 billion ARR at 28% share, and Google Cloud fights for 14%. But Azure is the lethal threat, closing in at $139 billion ARR with 21% share and printing $13.7 billion in operating profit on 63% surging growth. To fuel this machine, Microsoft executed a surgical workforce deep cleaning. A $900 million restructuring program cleared out 8,750 legacy employees under the Rule of 70, ruthlessly reallocating that capital straight to neural network experts and microchip architects. Simultaneously, they engineered a masterstroke in AI independence. Microsoft completely decoupled its risk from OpenAI, collapsing investment losses by 97% down to $14 million, while securing royalty-free IP until 2032. Internally, their proprietary MAI models are taking over. MAI, transcribed. 1 slashes GPU costs by 50%, voice. 1 generates 60 seconds of audio in under a second, and image. 2 boosts energy efficiency 4x. They are navigating intense global antitrust pressures, including a UK CMA probe into Windows Server, an FTC bundling probe, and a $24 billion fine risk in the EU. But the ultimate weapon to crush the competition is the $190 billion annual CapEx spend. This extreme capital requirement creates an impenetrable natural oligopoly, backstopped by a staggering $627 billion commercial backlog that guarantees future cash flow. Microsoft is forging the ironclad physical infrastructure for the next decade of civilization. Custom silicon autonomy is the foundation. The Maya 200 AI accelerator violently crushes NVIDIA Blackwell, pulling only 750 watts versus 1,400 watts, delivering 30% better ROI per dollar. The Azure Cobalt 100 CPU utilizes a custom 64-bit ARM architecture to completely obliterate multi-threading performance drops. This silicon powers their massive AI evolution, driving $37 billion in revenue and locking in 20 million Copilot users. They've even deployed a ruthless dual-model accuracy check, drafting with OpenAI and fact-checking with Anthropic's Claude to stop hallucinations cold. This all leads to the Windows 12 forced upgrade. Launching in October 2026, the modular Core PC architecture mandates a 40 TOPS NPU, triggering a massive, unavoidable global hardware refresh. The Surface strategy aggressively splits to capture this. ARM-based Snapdragon for battery life, Intel Panther Lake for raw enterprise power. The Xbox and mobile expansion completely rewrites gaming. Project Helix drops in 2027 with a custom AMD SoC, while the Xbox mobile store weaponizes massive Activision Blizzard IP to bypass traditional app stores. To fuel this entire voracious empire, Microsoft executed the nuclear pivot. A landmark power purchase agreement at the Crane Clean Energy Center guarantees zero-emission baseload power, coupled with Project Forge optimizing non-urgent tasks during renewable peaks. They're pushing server utility to an insane 90%. This is the most dominant, energy-efficient AI ecosystem on Earth. While revenue delivers explosive growth, Microsoft is controlling costs with absolute precision. Total operating expenses reached $17.7 billion. The apex predator here is research and development, expanding at a 9% compounding annual growth rate and tearing through $8.9 billion this quarter to secure elite AI talent and raw compute power. Meanwhile, sales and marketing compounds at a 5% rate, holding at $6.8 billion, and general and administrative grows at nearly 7%. The strategy is cold-blooded. Microsoft is pumping billions into AI innovation while trimming total human headcount, using their own tools to automate internal operations and forge a highly profitable compounding machine. The true market battle lies in the profit margins. Look at the multi-year trajectory. While the top line climbs continuously, net income has followed an explosive upward curve. From the 32% margins of 2022, profitability ripped upward to a staggering historical peak of 47% in the second quarter of FY26. Today, net income sits at a towering $31.8 billion with margins normalizing to 38%. Wall Street might flinch at this near-term compression, but make no mistake. This is the calculated direct cost of deploying a massive $190 billion annual infrastructure budget to permanently lock in global AI dominance. Quarter after quarter, Microsoft completely vaporizes Wall Street expectations. From $52.9 billion in 2023 to $82.9 billion today, reported revenue crushes the consensus without fail. Look at the forward curve. It is a vertical ascent. The fourth quarter projects $87.6 billion, aligning perfectly with management's guidance. Early FY27 models are already charging toward a monstrous $96.7 billion. Despite near-term panic over infrastructure costs, the forward projections are undeniable. The historic $100 billion single quarter is dead ahead, and Wall Street's models are still too conservative. The earnings per share trajectory doesn't just grow, it absolutely detonates. Non-GAAP earnings per share hit a flawless $4.27 today, violently crushing the $4.06 Wall Street consensus. Without a single exception, reported earnings have smashed the estimate bar every single quarter on this chart. The forward projections are towering, accelerating to $4.65, $4.78, and $4.86 through FY27. While some hedge funds panic over short-term infrastructure spending, the long-term profit inflection point is undeniable. Microsoft isn't just generating revenue. They're engineering relentless, compounding earnings power that will dominate the industry for the next decade. Institutional conviction is absolute, but let's read the tape. Microsoft just weathered a violent short-term correction, sliding back to the $405 level. The catalyst? Pure market panic over their massive $190 billion infrastructure budget, which even triggered an $8 billion block sale from a major hedge fund. But do not let the near-term noise shake you out of a generational setup. Look at the consensus. Out of 62 elite Wall Street analysts, 50 demand a strong buy and 9 say buy. There is not a single sell rating on the board. The institutional alignment is absolutely bulletproof. Now look at the price targets. The 12-month average sits at $560, unlocking an explosive 38% upside. But the Ultra Bulls? They are hunting a towering $870 target, a jaw-dropping 114% breakout. With the worst-case bear floor bolted at $400, your downside risk is barely 1%. The risk-to-reward ratio here is historic. The trillion-dollar AI supercycle is accelerating, and Microsoft is the armored monopoly running the entire show. The views expressed in this video reflect publicly available information and analyst research at the time of publication. This content is for informational purposes only and does not constitute investment advice. If this deep dive gave you the edge, hit like and subscribe. See you on next one.